Dow's second quarter 2026 earnings just crossed the wire, and they absolutely crushed consensus on profitability. I mean, operating EPS came in at $1.44. Think about that for a second. That is a massive swing from a 42-cent loss in Q2 of 2025.
Oh, yeah. It's a huge turnaround.
Right. And top-line revenue hit $12.1 billion, which is up 20% year over year. Management explicitly stated they beat their internal schedule on those self-help cost-cutting initiatives, too. They actually upsized their in-year target to roughly $700 million. And, looking at the pre-market, the stock is definitely reflecting that operational beat today.
Yeah, the market is loving it. And if you look at the forward-looking numbers they just fired off for Q3 2026 modeling, it tells the same aggressive story.
Let's hear those.
So they're targeting roughly $1.2 billion in operating EBITDA just for the packaging and specialty plastics division.
Wow. Okay.
Yeah. And then industrial intermediates and infrastructure is modeled at roughly $250 million, and performance materials and coatings is sitting at roughly $300 million.
So when you look at those headline figures in your portfolio, you are basically staring at a textbook V-shaped financial recovery. I mean, turning a 42-cent loss into a $1.44 profit on a 20% revenue bump is, well, it's the absolute definition of operating leverage playing out in real time.
Exactly. The leverage is incredible.
So we've got a stack of sources today. Dow's Q2 earnings release, the management call transcript, and a few fresh analyst notes that break down this new guidance. And the mission for this deep dive is really to look under the hood of that $12.1 billion revenue figure. We need to figure out how they engineered this massive EPS swing. Basically, is this just a cyclical bounce, or is Dow undergoing some sort of structural transformation?
Right, and to figure that out, the composition of that top-line revenue is absolutely the first place we need to look. Because, the surface numbers hide a much more complex operational reality.
Yeah, let's get into the mechanics of that top line. Because global sales jumped 20%. Which sounds like, booming demand across the board.
But it's not.
Exactly. If you look at the physical product moved, actual volume decreased by 1% year over year. So the heavy lifting on that revenue beat was almost entirely driven by local price increases, which surged 20% globally.
It's all pricing power.
Right. I mean, there was a minor 1% tailwind from currency, but pricing did all the heavy lifting here.
And management painted a picture of a global macroeconomic backdrop that is just highly fragmented right now. So they're operating in an environment that is generally stable, but incredibly mixed depending on, which continent you're actually looking at.
Yeah, it really reads like a tale of completely divergent economies. Like in the Americas, Dow is maintaining this very distinct low-cost feedstock advantage, and they noted a surprisingly resilient U.S. consumer. But then you contrast that sharply with Europe.
Where it's a totally different story.
Right. In Europe, they're facing persistent structural cost challenges. And then you pan over to China, where consumer demand remains really soft. And even looking back at the U.S., the housing market remains weak.
Yeah, we should really break down that feedstock advantage in the Americas, though, because it's the core engine that's allowing them to push those price increases. So in chemical manufacturing, feedstock is your raw material.
Right.
Dow has an infrastructure set up in the Americas that gives them massive flexibility across the naphtha to LPG range.
And just for those of you modeling this out at home, naphtha is derived from crude oil, while LPG, or liquefied petroleum gas, is derived from natural gas processing.
Exactly. So having the physical capability to pivot your input materials based on, daily commodity pricing is a massive structural moat. If oil spikes, they lean on LPG. If natural gas spikes, they pivot toward naphtha.
They just flip the switch.
Basically, yeah.
Yeah.
Dow's flexibility really outpaces the broader industry. They're optimizing their input costs in real time while simultaneously pushing 20% price hikes on their finished products.
Wow.
And European competitors who are dealing with structural energy deficits and higher baseline costs, they simply do not have that dual lever advantage.
See, I have to pressure test this dynamic, though, because as an investor, if I see a company relying on massive price hikes to mask a volume shrinkage, even a small 1% shrinkage like we're seeing here, the red lights on my dashboard start flashing a bit.
Sure, you worry about demand destruction.
Right. I start wondering if they're just squeezing a shrinking customer base. So is this actually a sustainable long-term growth strategy? Or are we just looking at a cyclical sugar high that's going to crash?
It's a fair question. Evaluating the sustainability of pricing power is like the primary risk assessment for any industrial compounder. But context matters immensely here. Dow operates at the very beginning of the global supply chain. They are foundational.
Right.
So when global supply tightens or input costs rise across the board, they are forced to raise prices just to protect margins.
And the market just absorbs it.
The market absorbs it because it has to. Securing a 20% global price increase without triggering a massive double-digit collapse in volume is a testament to the essential nature of their product mix.
Yeah, that makes sense.
A 1% volume dip against a 20% price hike. That demonstrates incredible demand, elasticity, and market dominance. It basically proves they aren't just a commodity price taker, they are a price maker.
Okay, so let's trace where that pricing power was actually deployed to see if the strategy holds up at the segment level. The undisputed heavyweight this quarter was packaging and specialty plastics, or P&SP.
The numbers here are wild.
They are staggering. Sales hit $6.4 billion, which is up 27%. But the operating EBIT, the earnings before interest and taxes, skyrocketed to $12,278 million.
Unbelievable.
I mean, that is up from a meager $71 million a year ago.
Yeah, that is where the operating leverage you mentioned earlier really shines through.
Right. And local price for the specific segment was up 30%, driven heavily by higher polyethylene prices across all regions, especially in flexible packaging. Meanwhile, volume actually dropped 4%.
And we should note why it dropped.
Right. Management noted this volume drop was largely due to planned maintenance in their hydrocarbons and energy business at the U.S. Gulf Coast, plus a recently restarted EMAI cracker, that's their Europe, Middle East, Africa, and India region.
Right. And the mechanics of the margin expansion in this segment really come down to integrated margins. Dow isn't just buying raw plastics and reselling them. They're operating the crackers, which are these massive industrial facilities that literally crack heavy hydrocarbon molecules under extreme heat and pressure.
It sounds so sci-fi when you describe it like that.
It kind of is. They use that process to create lighter, essential building blocks like ethylene, which is then turned into polyethylene.
Which means they capture the margin at every single step of the process, from the raw hydrocarbon all the way to the specialized, flexible packaging film.
Exactly. So the higher polyethylene prices they commanded in the open market, those directly translated into higher integrated margins across their entire internal supply chain. Those higher margins heavily out-earned the temporary financial drag of having major facilities offline for maintenance.
I really like to think of this P&SP segment as the engine room of the company. It's like they took the physical engine offline for planned maintenance, which explains that 4% drop in the physical volume they produced. But the unit economics on the fuel going into that engine are running so hot on pricing that the overall profitability still goes parabolic.
That's a great way to put it.
Right. Even running at 96% capacity, they generated exponentially more cash than they did at 100% capacity last year.
Yeah, the physical output dipped because the machines were being serviced, but the financial output exploded because the profit spread on every single unit they did produce was dramatically wider.
So while that engine room was a clean win for margins, the other two segments show the very real friction of those global headwinds you outlined earlier. Let's look at industrial intermediates and infrastructure, or I&I.
The mixed bag.
Exactly. Sales rose 14% to $3.17 billion. Operating EBIT hit $246 million, which is recovering from a $185 million loss in Q2 of last year. However, volume here was actually down 2%. And a major headwind cited for that volume drop was the ongoing Middle East conflict, which is weighing heavily on their polyurethanes and construction chemicals business.
Yeah, you are really seeing geopolitics and macro interest rates playing out directly on the income statement here. So polyurethanes are heavily used in insulation, construction foams, durable goods.
Housing stuff.
Right. When you have a weak U.S. housing market due to affordability issues, combined with disrupted shipping lanes and geopolitical instability in the Middle East altering regional demand, the physical volume of construction chemicals is naturally going to compress.
It makes total sense. Then you have performance materials and coatings, or PM&C, which is frankly the anomaly of the quarter. It completely breaks the pattern we saw in the other segments.
Yeah, this one is interesting.
Sales for PM&C rose 11% to $2.36 billion. And unlike the other divisions, volume actually increased 6%, led by growth in downstream silicones.
Right.
Yet despite higher sales and higher volume, operating EBIT actually fell by $19 million down to $133 million.
Yeah, rising volume and falling profits is a divergence that always requires a deeper look in any earnings report. In this case, it comes back to the cost associated with reshaping the physical footprint of the business. The higher fixed costs essentially ate the margins.
How so?
Well, specifically, Dow had significant turnaround activity in the quarter, and they absorbed the upfront costs associated with the strategic shutdown of their upstream siloxanes plant in Barrie, UK.
Ah, so they took a physical hit now to fix the foundation for later.
Exactly.
We'll get into the strategy behind that UK shutdown in a minute, but speaking of fixing the foundation, I want to zero in on a really fascinating accounting maneuver in that I&I segment that caught my eye. Management noted they suspended the recognition of equity losses from their Sadara joint venture, and that suspension acted as a major boost to their EBIT.
Oh, yeah. Accounting for joint ventures can heavily skew reported earnings if you don't understand the underlying mechanism.
Which is why I want to unpack this. Because to a retail investor, suspending loss recognition sounds a little bit like financial dark magic. How does stepping away from funding a joint venture act as an immediate financial tailwind on an earnings report?
Okay, so when companies form a massive joint venture like Dow did with the Sadara chemical complex in Saudi Arabia, they use what's called the equity method of accounting. Instead of consolidating the entire joint venture's revenue and expenses into Dow's own books, Dow just recognizes its proportional share of Sadara's net income.
Meaning they recognize their proportional share of the profits, but critically also their proportional share of the losses.
You got it. And if that joint venture is bleeding money due to market conditions, Dow has to record that loss on its own income statement, which drags down Dow's reported EBIT. But, and here's the key under accounting rules, a company only recognizes those equity losses up to the amount of money they have actually invested or legally guaranteed to the venture.
Ah, so there's a ceiling to the pain.
Exactly. Dow reached the absolute cap of their existing relevant obligations and commitments. So from Q1 2026 forward, they effectively fulfilled their legal financial backstop. Because they're no longer contractually on the hook to fund Sadara past that guaranteed amount, accounting rules dictate they are no longer required to reflect their share of Sadara's ongoing paper losses in their own earnings.
Okay, so it's not dark magic at all. It's just reaching the legal limit of your liability.
Right.
The JV might still be losing money, but that bleeding stops hitting Dow's income statement. It's an immediate financial tailwind because a major expense line item just vanished from the ledger.
Yeah, it cleans up the earnings profile significantly.
Which is a perfect segue, actually, because beyond the macro pricing power, the segment quirks, the joint venture accounting, management's internal cost-cutting is the actual safety net underpinning this entire earnings print. They are labeling this initiative self-help.
Such a great name for it.
I love that term. It signals to the market we aren't waiting for the macroeconomic weather to improve. We're fixing the roof ourselves.
And the scale of this Transform to Outperform program is substantial. I mean, they delivered over $300 million in in-period benefits this quarter alone. They aren't just trimming around the edges here. They are aggressively restructuring their operating model. Management upsized their 2026 target for this program to roughly $700 million, and they kept their overarching $2 billion target for year-end 2027 entirely intact.
Furthermore, they noted that their $1 billion in 2025 cost actions are now materially complete. When you combine that level of structural cost reduction with their current balance sheet, you are basically looking at a fortress. Cash from continuing operations was $1.3 billion. Total liquidity sits at around $14 billion. They maintain shareholder returns, distributing $253 million via dividends, and, we can't overlook the massive cash injection they secured from the NOVA litigation.
Right. The NOVA Chemicals patent infringement lawsuit payout. That is a massive liquidity event. They received roughly $1 billion in Q1, with the remaining $300 million or so expected in Q3.
Injecting $1.3 billion in cash into a company that is already slashing billions in structural costs. I mean, that gives management an incredible amount of capital allocation flexibility.
It really does. And if you connect this fortress balance sheet and these self-help initiatives back to Dow's strategic portfolio shift, it paints a very deliberate picture of where the company is actually heading. Let's go back to that Barrie, UK plant shutdown we discussed in the PM&C segment.
Right, the one that hit margins.
Yeah. That wasn't just a random cost cut to hit a quarterly target. By shutting down that specific upstream siloxanes capacity, they're intentionally shifting their silicones mix.
And shifting the mix implies they're walking away from revenue on purpose.
They absolutely are. They're moving their product mix by greater than 25% toward higher margin businesses. The strategic goal here is to transition away from merchant participation toward captive participation.
Let's define those terms because that shift really is the core thesis of DOW's evolution right now. Merchant participation is essentially when you create a basic commoditized raw material and sell it on the open market to other manufacturers.
Right. Think of it like a company grinding wheat into flour and selling it in bulk to bakeries.
Okay, I like that analogy.
The margins on bulk flour are incredibly thin. You're subject to fierce global price competition, and you have zero pricing power if a cheaper flour mill opens up right next door. Upstream siloxanes are basically the chemical equivalent of that bulk flour.
And captive participation is the opposite. That's when you use your own raw materials, your own flour, to create higher value specialized end products.
Exactly. You stop selling the flour to the bakery and you start baking artisanal cakes yourself. In chemical terms, Dow is taking those raw siloxanes and formulating them into highly specialized downstream silicones, things like advanced adhesives, thermal coatings for electronics, or specialized sealants for electric vehicles.
So they're trading high-volume, low-margin merchant business for lower-volume, highly defensible, high-margin captive business. Shutting down the UK plant was just them closing an inefficient flour mill so they could focus capital entirely on the bakery.
Nailed it. And tying all these moving parts together into a cohesive thesis for your portfolio. You have a company that is enforcing massive 20% price hikes to protect its integrated margins. They're deliberately shutting down inefficient European merchant plants. They're capping their liability on joint ventures. And they're wringing billions of dollars out of their own operating structure through this self-help program.
It really is a masterclass in controlling the controllables.
It is. And I want to leave you with a forward-looking thread to mull over as you track Dow's trajectory over the next few quarters. Throughout this report, and the analyst commentary, there was repeated focus on the rising demand for data center applications across all of Dow's segments.
The AI infrastructure build-out.
Exactly. The physical infrastructure required to run generative AI models generates immense amounts of heat. Traditional air cooling is reaching its physical limits in these data centers. And Dow just launched the Dow Coolant Care Network, providing advanced liquid thermal management solutions, immersion cooling fluids, and specialized testing specifically for these massive data centers.
Which perfectly aligns with that shift toward captive, high-margin, specialized products we just talked about.
Right. With these new high-tech revenue streams opening up and aggressive cost cuts sheltering their balance sheet from macro volatility, it raises the ultimate question for investors. Is Dow successfully transitioning away from being a purely cyclical chemical manufacturer battered by every breeze in the global economy and evolving into a highly insulated, margin-controlled industrial compounder?
That's a great question because if they can maintain their pricing power while pivoting into data center thermal management, the multiple this stock trades at could look very different in a few years. That is the exact question you have to ask when modeling out this V-shaped print. We'll be keeping a close eye on how that transition from merchant chemical supplier to high-tech industrial partner plays out in the coming quarters. Be sure to follow the show for daily earnings coverage, institutional-level analysis, and to stay ahead of the curve on how global macro trends are hitting the bottom line.